Joining us now is Kathy Bostjancic, chief economist at Nationwide Mutual. It's good news, Kathy. We want people to make more money, have more jobs, be more prosperous. That's what it's all about. Do you think, though, that this number, being pretty good, does change Fed thinking?
Well, Brian, happy to be with you. I think, if anything, it's going to embolden them to continue to raise rates to a restrictive level. They've been very resolute in saying that inflation needs to slow down. Unfortunately, today's numbers don't really support the idea that it's going to slow rapidly. And particularly, Chairman Powell spoke about that earlier in the week, this connection between wage growth and core services, excluding the rental market, right? Because we all know that rental prices in real time, the inflation's slowing. So unfortunately, it could continue to keep the economy running a bit hotter. In fact, we look like we're on course to accelerate in the fourth quarter to over 3%. And meanwhile, the Fed wants things to slow down. They don't want to obviously throw everyone out of a job and to have a recession, but they would like to see below potential growth rate. And in fact, we're getting just the opposite.
Was there anything in the jobs number that alarmed you at all, or was it pretty much good news across the board?
Well, it's really good news in terms of activity, but the wage number, clearly was shocking. You saw the overall increase month to month pick up, 0.6, and many of us, including myself, were looking for just a 0.3 increase, which still is quite healthy. If you annualize, that's 3.6. Pre-pandemic, we were running 3%. So now we're at, we're still at, over 5% in terms of overall wages, and then production workers, it's even higher. We're running at 5.8. So that's just too hot. That's too good for the Federal Reserve, and I think, unfortunately, for the markets. Now, the markets took it in stride today. As you said, both the bond market and the equity market, quite surprising, actually. And the bond market's still looking for the Fed to ease next year, and I think that's the problem. I think that's where the markets get tripped up. I think this is the Fed saying, we've got to slow things down. We're going to raise rates to at least 5% and hold it there for a year.
And are you in the we will have a recession next year camp?
Yes. Unfortunately, I do think it takes a recession to cool things down, but we're in a moderate camp. Typically peak to trough in a recession, exclude the great financial crisis and COVID, a decline of 2%. We're looking for a decline of 1.6%. So, not mild, but kind of a more moderate. But then balance sheets still look good. So that could help, even as we come out of the recession.
Yeah. And what would that change then? If we get this mild recession, and let's hope if we get one, it is mild, does that necessarily mean then the Fed pivots and starts cutting? Because that's kind of now the debate. The rate hike debate's kind of over. I mean, we know hikes are coming, but they're closer to being done than starting. The next debate, as you know, is going to be, okay, when do they pivot, or do they just stay put for like 3 years?
Yes, that is definitely the debate, and the markets are weighing in and saying, we think they're going to start cutting rates, possibly by the middle of next year, certainly by Q4. We just think that's too quick of a turnaround for the Federal Reserve, just given all the evidence we've seen so far, the data and inflation. We think 1 year, get it to a bit above 5%, hold it for a year. That should be sufficient. But it's really going to depend on the inflation numbers, right? And we now know what to focus on. It's core services, excluding real estate or rental prices.
Kathy Bostjancic of Nationwide Mutual. Real pleasure to have you on again, Kathy. Take care. Thank you.
Thank you, Brian.